significantly. How much is that's materially higher as a result of the backdrop with the war, as well as some of the commodity prices? Does that challenge some of the fundraising, or is this the haven? Is this going to be safer than some of the governments because people have that much faith in the AI promise?
It depends by how much yields and rates would go up. Of course, that is a variable that's important to everyone. But these companies are particularly unique, highly rated, the likes of Microsoft. Out of everyone right now, who has the capacity to issue debt? These companies have tons of capacity to issue debt. So if you're thinking about runway, sure, if they want to, they've got the ability, if they've got the willingness to carry on issuing debt to fund this, sure. The pushback, the ROI. It's on the equity side of things. If you start getting pushback there, that I think things start to change pretty quickly. We're starting to see that on the margin with companies like Meta, Microsoft kind of getting closer to that moment, but we're not seeing that massive moment where the equity market just says, nope, no more, you're done here.
I feel like these companies have bigger market caps than most countries out there. If you look at, for example, the Alphabet market cap, it is twice the valuation of the FTSE in London. So you start looking at some of these valuations and you wonder when some of their yields might trade inside government bond yields.
We had that conversation last year, didn't we?
We're going to have it again.
Yeah.
I actually do think that we're going to end up having that conversation, especially if they do show the ROI on some of these investments.
We'll come back to that with Jonathan Golub of Seaport Global a little bit later in the programme, I think in the next hour or so. Let's turn back to our top story. Crude rising as the US and Iran remain at a stalemate on a deal to end the war and reopen the Strait of Hormuz. Ruqaiya Ibrahim of reflect a tightening oil market. Ruqaiya joins us now for more. Ruqaiya, welcome back to the programme. That quote, of course, was true last month and a month before, and we haven't seen crude explode higher. Why do you think we might be closer to that moment?
Good morning, Jonathan. Thanks for having me on. So I think as we move further out and the Strait of Hormuz remains closed for longer, what we're seeing now is that there's this buffer of massive inventories that are shielding the oil market temporarily. But ultimately, these are stocks and their ability to shield the market is not infinite. And as the Strait remains closed for longer, these inventories will continue to draw down. And that buffer is removed. And so I think that as we move into, further weeks and months ahead, if the Strait is not reopened, the path of least resistance for oil prices will be higher.
I'd really appreciate your best guess. So the blockade continues and the administration wants to put more and more pressure on Iran to hopefully get to a moment where they breach storage capacity and compromise their wells. Meanwhile, Iran's trying to sit this out. The blinking contest from their side looks like this. You've got all these inventories and we're waiting for you to drive down your inventory so you feel the pressure. Who do you think gets where first?
That's a great question. So I think that, what we're going to see is that, Iran has proved to be quite resilient in terms of their pain threshold. And I think that, going forward, I would not count on them blinking in the face of greater pain. So I think what we're going to see is that the oil market is going to eventually bear the brunt of this. We've actually have seen quite a stable oil market for the past month or so. And, as I mentioned earlier, that just reflects, the buffer that we've had from the inventories, things like US exports surging, China cutting back on their imports. But as this prolongs, these buffers are going to sort of wear thin and their ability to shield the oil market is ultimately going to weaken.
Ruqaiya, which of the Gulf countries are most exposed financially to the prolonged conflict, should it go on for a longer period of time?
Yeah, so Iraq is definitely exposed here. Their inventories were the first to be filled, and so they've had to shut down their production, quite a bit very early on in the conflict. The other Gulf producers, so for example, Kuwait has also shut down a big share of their production. Bahrain, similar situation there. And then the ones that have been able to sort of weather the storm better are the ones that have the pipeline bypass capacity. So that's Saudi Arabia and the UAE, which are still able to get crude out of their countries by bypassing the Strait of Hormuz through either the East-West pipeline or the port of Fujairah in the UAE.
Are there similar offsets, not just for crude, but for other commodities as well? Because we point to the fact that we are focusing on crude, but we're seeing, for example, cooking oil prices rise 5.6% in a month. This is affecting many other commodities. What's your sense of what else is getting through and how?
Yeah, that's perfectly correct. I mean, what we're seeing also is that there's a massive disruption to fertilizer, which of course is also a byproduct of the energy sector. And so that's translating into upside pressure on agricultural commodities. And also, things like the closure of the Qatar Energy's Ras Laffan plant is also a disruption to the fertilizer industry. And so, as this closure of the Strait of Hormuz prolongs, that also buffer where, you have sort of the planting season that's taking place, the spring planting season. And as the crops, sort of progress and the harvest season comes and that fertilizer is insufficient, that also poses a massive upside risk to agricultural prices and all those byproducts that come from that.
Brent Crude this morning around 1:04. Ruqaiya, thank you. Ruqaiya Ibrahim there of BCA Research. New note from HSBC. New price target on the S&P, 76.50 on the S&P 500. It was 7,500. The title of the piece, though, that got my attention. S&P 500.
I've seen this from one person after another as they point to just how much earnings have rocketed higher. Now it's up to NVIDIA. On May 20th, how much do they change the narrative in some way or just build on the idea that those profits just keep rolling in?
Tech could re-rate. IPOs set a higher bar for valuations. Laggards catch up as the geopolitical and trade uncertainties fade. AI efficiency gains broaden, margins expand, a Goldilocks backdrop. This
is something that Andrew Hollenhorst and the team over at Citi had pointed to. You're seeing wage growth tend lower and pretty consistently over the past, if you look at the 12-month rolling average. And if you look at that, you could see a pathway to the Fed looking at some of these inflationary pressures as transitory and seeing a path to cut rates, especially with the Kevin Warsh Fed. All of this is predicated on this conflict ending, and right now we don't see a path to it.
Nasdaq futures up by a tenth. S&P 500 futures just about unchanged. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Pakistan is negotiating with Iran to allow Qatari LNG shipments through the Strait of Hormuz, with the first cargo since the war began already in transit. Pakistan, which is mediating between the U.S. and Iran, is struggling with a gas shortfall and battling widespread blackouts. Energy Secretary Chris Wright saying the Trump administration is open to suspending the federal gas tax.
All measures that can be taken to lower the price at the pump and lower the prices for Americans, this administration is in support of. We are constantly looking for different ideas. We've taken a number of actions.
The U.S. national average for a gallon of gas is $5.52, including the 18-cent tax, up about 50% since the Iran war started. And the New York Knicks are back in the Eastern Conference Finals after sweeping the Philadelphia 76ers. The Knicks advancing to the East Coast Finals for the second straight season and will play the winner of the Cleveland-Detroit series. That's your Bloomberg Brief. John?
Yahara, thank you. Just want to confirm that is not why Anne-Marie isn't here. She's on her way to China. She'll be back with us in the next couple of days, delivering coverage from that. But I can tell you she's very happy about the outcome of that result over the weekend. Up next on the programme, balancing the dual mandate.
2 months in a row now, we've had blockbuster jobs numbers. Pretty much it was green across the board. And so what it means is it's a rip-roaring jobs market.
Up next, we'll catch up with Matt Hornback of Morgan Stanley.
Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive. Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that... And this is The Pulse, every weekday, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Sharian in Seoul, and this is Bloomberg.
We often play this game if I told you at the start of March, Strait of Hormuz has just shut down. This will continue through to early May, but in early May, what you'll see is a series of people on Wall Street upgrade their price targets on the S&P 500. You'll be shaking your head. Why, really? How? How's that possible? Earnings is how it's possible. We've seen a series over the weekend. Lori Calvasina of RBC, new 12-month price target, 7,900 on the S&P 500. Year SBC for 7,650. Not bullish enough, apparently, at 7,500. Ed Yardeni, he gets the headlines. He's looking for 8,250 now on the S&P year-end off the back of this powerful earnings story.
The story has actually superseded even the gains that we've seen so far, even though they are absolutely moving into moonshot territory. At a certain point, people are looking to a question of when the Strait of Hormuz will open and the potential boom conditions that we've had there not been some sort of constraint coming from higher oil prices. If that eases, then Yardeni unleashes the of his roaring 2020s that evidently is more than half over.
The guys who really deserve the credit, though, the guys over at Barclays. Their team actually raising the price tag on the S&P right in the thick of it, near the end of March, right in the thick of it, where things were getting a bit scary. And then they raised their price target higher, ignoring the Middle East and focused on the earnings.
Notable that they're getting more cautious now and actually going market weight because they think that maybe some of these gains have already reached the point where they can stay for a while.
Here are the scores this morning. Futures just about unchanged on the S&P 500. On the Nasdaq going nowhere also. On the Russell down by close to 0.1%. Crude is elevated, inching higher, Brent and WTI. And bond yields grinding higher as well, up by 3 basis points on 2s. Likewise on 10s, your 10-year 440. The Fed in focus, under surveillance this morning, balancing the dual mandate.
2 months in a row now we've had blockbuster jobs numbers, and the really interesting thing is that we look at these things that you guys do too, I'm sure, called heat maps, where you look by category, like where's the green and where's the red, and pretty much it was green across the board. And so what it means is it's a rip-roaring jobs market.
So here's the latest this morning. With the job market showing solid signs of gains, Fed officials are turning attention to a fresh batch of inflation data due out through this week, starting with CPI tomorrow. Joining us now is Matt Hornbeck of Morgan Stanley. Matt, good morning. Good to see you.
Good morning. Thanks
Set the
for having
stage for us. What are you expecting from CPI, PPI, the inflationary reads this week?
Yeah, so this month we're definitely going to have a bit of a spicier inflation report. Ultimately, it matters how all of these inflation numbers that we get this week come together to form a PCE inflation forecast. So we've got CPI, PPI, import prices. All three of them contribute in their own ways to what we end up getting in PCE. And of course, that's the important number for the Federal Reserve. That is the inflation metric that they are targeting for now. perhaps, for now.
You think that changes?
No, we don't. We don't. I was just baiting you a bit.
Don't bait me and then say that. Kevin Walsh suggested maybe in his hearing that things might change.
There are 1,000,001 ways of slicing and dicing inflation data, and if you take out enough of the line items, you will get the number that you want to get. I do think, though, that there are some really interesting research notes out there that do look at different types of trim mean measures of inflation. How are you supposed to trim one side versus the other? It's a fascinating topic, and I actually look forward to any research that the new Fed will end up delivering to us.
The fear is that the new Fed will look for a framework that can give it a green light to be more dovish in the light of inflation that still is running hotter than expected, but also that isn't necessarily transitory. How much is the market pricing that reality in right now?
So when we look at CPI fixings, it's a smaller market. It gets a lot of attention from people that do a lot of work on inflation. You actually see inflation coming down in that market price quite a bit into the middle and end of the year. You know, the question is, how much of that decline in inflation that's priced into the market is truly an expectation amongst investors? How much of it is risk premium amongst investors? Because we know oil prices are moving quite a lot every single day, and they can have a big influence on the path of inflation into the end of the year.
Okay, I understand all of that and why you could say that's transitory, why it has been in the past. At the same time, if you look at core PCE, the key metric that the Fed looks at, it actually is rising faster than CPI, and it's on the heels of a lot of the infrastructure spending by the hyperscalers. This is the AI trade coming out in higher inflation that is going to be passed along to people in the form of higher goods in different pockets. At what point do you have to look at that and say structurally there is a higher inflation embedded in here, regardless